My name's Joel Fleming. I'm the portfolio manager of the UBS Microcap fund, and I have the privilege in my job of investing clients' money in small and emerging companies. Every day we're conducting meetings with management teams, understanding businesses, and going on a journey with these companies in their successes, their failures, and really getting to see the development of these businesses over time. It's such an interesting role. We learn so much, and just the history that you build over that time is fascinating. Little quirk, and when we sent out the invitation to this, I had about 200 people telling me that I don't work for UBS anymore, I work for Yarra, and I need to change the invitation. UBS entered into a partnership with Yarra in December 2018. They're a boutique funds manager with a long track record here in Australia, being a management buyout from the Goldman Sachs Group. And why I mention that is there are a couple of key points. As a fund manager, I sit there and analyse businesses all the time, every day, making judgments on the people, the structure, the opportunity. And it's very interesting that as part of that, in terms of the business that I work for, I want that to have the building blocks of success as well. So the first thing about microcap companies, 95% is the people, the culture. Are those people willing to do what's necessary to go on the journey, to make great strategic decisions, to build out their business and take advantage of this opportunity that exists? So the key is people and the team and having a good, robust platform in place. The other thing is in alignment. As a part owner of the business, I think differently about decisions I make. As an owner, you think like an owner. Should we be spending money there? What are the risks? What are the opportunity? What's worth pursuing? Incentive is not a silver bullet. At the end of the day, there are plenty of people that own lots of shares that are very good at telling a story and focusing on promoting a stock and not actually promoting the underlying business. But it's an important backing to any successful business, that alignment. The process has to be repeatable. The way that we look at businesses, we go through a process to work out whether that's a valid investment for our fund. And very similar to a business going about trying to grow, it's about sometimes you need to change, pivot, sometimes things require more work, but you have to have a strong basis and foundation and belief in what you're doing. ESG's a real buzzword at the moment. It's very important. We look at it from the perspective of if your business isn't sustainable, if it's not durable, if you're not doing things today that mean that you're not going to be there in 5 years, then that is not a good investment for us. So having that basis of sustainability and durability is really, really important. Microcaps, as we know, many fantastic opportunities. As Craig said, some of the examples of stocks that have presented here and the returns, amazing. One of the big issues is, as a portfolio manager, is avoiding the blow-ups. That's more than half the job, I think. Picking the winners is great, but if you can avoid the blow-ups, that risk-return trade-off changes, dramatically. And, it's fantastic to see an event like this that's been going for 10 years. Our fund's been going for 5 years. This is about building a long-term track record and growing with these businesses over time, which just offer, so much potential. Undiscovered, doing things today which mean they're going to be these small and large business of tomorrow, driving great returns for investors. Sometimes I think it's worthwhile just segmenting the market. We all know about the ASX 100, the largest listed stocks in Australia, dominated by the banks, big brand names. When we look into it, in front page of the Fin Review, generally focusing on these kind of businesses. Business media, the amount of funds that are actually looking at that particular segment of the market, and the fact that the sell side, or the stockbrokers, around 11 analysts per stock. So what we would say is that's a reasonably efficient market. There is a lot of focus, there is a lot of tension, and there's a lot of detail. And the other thing, it's very concentrated. The financials make up about 34% of that investable universe. So you've got big sector concentration there. And if a major event happens that affects the banks, it generally will affect them all to a great degree. Where in microcap investing, you can have exposure to the technology sector, but the individual drivers of those companies are very different. So you don't have that concentration risk. We then move into small caps. They've increasingly, over the last 15 to 20 years, become a very valid part of asset allocation. They tend to be higher growth companies than the large caps. You've got more diverse sector exposure. Often they're brand names that have built up over time. Super Cheap Auto, Baby Bunting, businesses like this that we are aware of, we've walked past and we understand. And then finally, we've got microcaps, and there's no great way to define the microcap segment. But if we look at the emerging companies index, we can see 156 stocks, market cap medium of around $200 million. And that's the area that we try and focus on. And over time, this has become an increasingly relevant part. As Craig said, Acorn Capital helped pave the way for microcap investing a long time ago. And over time, that this has become a much bigger part, more acceptable part of people's portfolio. Because in an environment where generating long-term capital growth, and that's what we're trying to do here, is rare, this is one part of the market where that opportunity exists. And we think the case is compelling for investing here. We looked at 650 names comprising around $55 billion of market cap when you look at between $300 million and $50 million of market cap. So you've got 650 names to choose from. And within that group, you've got amazing exposure across the full range of the Australian economy. So by sector and by stock. The ASX has been very good at allowing new companies to list, backdoor listings, and any kind of emerging trends you'll generally see happening in the microcap space, from whether it be medicinal cannabis to cybersecurity. Whatever is happening on a global scale, there'll generally be a exposure in the Australian microcap sector. So you have that choice. These businesses, while they're developing, they also tend to be growing faster because they're coming off a low base. And a great company is one where it's providing a better product or service, doing something smarter, doing it cheaper. And these examples are where, you know, a business has a right to exist. And consumers are far more fickle these days. We don't just roll over contracts with our phone providers anymore. Cost price information is available everywhere. Very, very competitive for the consumer's dollar. And the other thing that's fantastic about microcap investing is you can find pure sector exposure. So many years ago, we thought that the idea of this digital transformation was a very powerful thematic. How do I find exposure to a company offering data centers, which is at the epicenter of this? Offshore, we'd seen a business like Equinix go from strength to strength. Telstra had data centers within their business, but it's such a minute fraction of their overall revenue that it's very difficult to find that pure exposure to this. So a listed company like NextDC gives you that pure focused exposure. And that's another really important element of microcap investing. And if I was to sum it up, we've just got lower investor focus, less sell-side coverage, often none. I will often go to a company and no one's been to visit them for 6 or 12 months, even though potentially things are starting to improve in terms of their business. And there's a lower level of media interest. So often, you know, a ticker that no one's even aware of. And that creates the opportunity. It's inefficient, it's large, and if we're active and fundamental and you take an interest, opportunities exist. And even though there are more microcap managers than there were a number of years ago, you can't run a lot of money in these strategies. These are not billion-dollar strategy funds, because you need to be nimble, you need to be dynamic, and therefore that pushes many people away from the idea of launching products in this area, which is another advantage. So this is the nursery for the small cap and the large cap of the future. It provides long-term capital growth potential, and the fact that we're dealing with more risk because these businesses are at an earlier stage of development represents the opportunity. I thought this chart is really interesting because one of the other themes that's happening is the world is changing rapidly. Now this is a chart of the largest public companies by US dollar from 2000, 05, 10, 15, 2019. General Electric, Exxon, Cisco, Walmart, these are businesses that have just over decades continued to invest and grow and become the behemoths we know, acquire. It's interesting as you watch through time, whether it be an oil price, whether it be a commodity, whether it be banking and finance, the movement in some of those stocks, we see pre-GFC, the likes of Bank of America and Citigroup being some of the largest companies listed in the world. We move forward to 2019. That's a pretty tech-heavy list of the world's largest companies. I mean, Facebook was started in 2004. You compare that to an Exxon or a General Electric, that reshaping of the economy is really clear coming through this table. And it reminds us that structural change creates great opportunities for companies. And if you're a small company starting with a clean sheet of paper and trying to think, how do we do this better? How do we create a business here? That's a really great space to be operating in. As we said, not adopting to change on the other side has seen many great businesses fall by the wayside. And it's a stereotype to pick on them, but Blockbuster Video, Kodak, the Nokia phone, the examples are long and endless of businesses that have been disrupted and haven't been able to adapt to change. The other trend that we point to is technology has enabled businesses to scale more quickly these days. So previously, if I was manufacturing a product, I would have to go and get a new factory space. I would have to get some equipment. There's planning and development. There's all sorts of issues that go into it. To scale many businesses today, I just need to go and find more like-minded, capable people to grow with me. They're asset light. They're driven by people. And if we think about those businesses today, Facebook 2004, most people would have used Uber. I mean, that's only been around for 10 years, and we can debate the economics and the value of the business. But the fact is, out in the street today, that is a viable option that has caused havoc to the taxi industry. And the other big trend that we point to in terms of structural change is changing the way in which we consume. If you think about the idea of streaming services versus going to the video store, classified newspapers, free-to-air TV, it's really interesting to look back and say Fairfax as part of the Nine Group is a small cap today. Yet realestate.com, Seek and car sales are in Australia's top 100 companies. Fairfax was the dominant force in classifieds, and yet that structural change has seen such a shift in value within these companies. And that's the opportunity. These businesses were once microcaps with a plan, usually run by the same people, operating in this structurally shifting environment, and they've created amazing value for their investors. Another thing I thought would be really interesting, because you've got to retest this, but in 2009, S&P and ASX launched an emerging companies index, a microcap index, and it was 128 stocks and the premier benchmark to start looking at microcaps. And that was a really positive move because it showed the increasing relevance of the asset class. I think there was a view previously that this was just punting and, stocks that would never go on to do anything. They could just tell a good story, but the asset class has certainly become increasingly relevant. It's a realistic part of people's growth portfolios today, and that opportunity that exists to drive long-term capital growth is just really, really powerful. So if we go back to the initial launch of that index in 2009, and we think about, it was actually dominated by energy and materials sector. 2009, we saw the bottoming of the GFC in terms of most indexes. But I thought this was fascinating that Carnarvon Petroleum and Mincor Resources are actually still listed today, and their share prices have actually done this. They're very volatile industries, oil and gas for Carnarvon, nickel for Mincor. But it's an example of businesses that over a journey can reinvent themselves and do different things. So Mincor previously was mining nickel, and it's about to restart production in the next 12 to 18 months mining nickel. But the assets are different, the outlook for nickel is different, and the global environment is different. What's really interesting as well about this list is Biota, SMX, Customers, Mantra, Oakton, Industria have all been subject to corporate activity. And that's in the space of 10 years. So this is also a fertile ground for companies that are seeking to add capability to what they're doing. And often we see large companies buying small companies to either they're doing something differently, which is a threat, or looking to add to their overall mix. And again, looking through that list, 10 years ago, if I was to pick out some names, and I think similar to Craig's conversation, here are some examples, first day of that index of stocks that you could bought. What I think is really interesting about this list, these are businesses that are still listed today. But if I said to you, I'm going to show you a pizza business run by an enthusiastic guy called Don, who holds a lot of stock in the company, it's sub $250 million market cap, it's profitable, it would be very difficult to believe that 10 years later that would be a top 100 stock with $4.4 billion of market cap. A significant return for investors over that period, $3.40 to $50. But these are the opportunities that exist. And what gives me great confidence about what we're doing is the fact that many of these businesses are still in exactly the same areas that they were focusing on. Often the management team may have transitioned over that period, but often that management is still there driving the strategy. And at the end of the day, this is about finding these companies that can grow significantly and really add value to your portfolios. In terms of how we think about investing, the economic outlook is uncertain. You would say that there is a laundry list of global worries out there at the moment. And Australia's travelling along okay. House prices are on the up in Melbourne and Sydney. Interest rates cuts. We've got money coming back through tax returns. Employment up. Wages growth up. There's a lot to be positive about. But I think people are a little bit worried about why the RBA is cutting rates, why they're talking about QE, what's happening with global trade wars, Brexit, Middle East uncertainty. There are a lot of things to be concerned about. The advantage of microcap companies is we're looking for things that are able to grow outside of what's happening in the macro. Because we're selling a better product, we're selling a better service, we're offering our customers more, or there is a change in the way that people are doing something that means these companies have a right to exist and thrive. And that's really advantageous, I think, when markets are tough. Finding businesses that are doing well means that they're rewarded more fully for that. And we think that that's a really good backdrop for being able to differentiate ourselves in that area. At the end of the day, we're looking for sustainable growth. So we've got this large investable universe to flick through. We're finding these businesses that are growing their market shares, that are winning, that are succeeding, and they've got that operating momentum that means what they're doing today, the investments they're making, means that they're going to be much, much larger companies, more robust companies, employing more people, paying more taxes, doing all of those good things in the future. And that's what we're looking to do. And we continue to look at opportunities to back companies from an early stage. In microcaps, when you're investing in this space, you're taking on greater risks. These businesses are more volatile. We have a situation where, you know, they're still growing. They're not financing themselves completely. They're still not on a completely sound footing. The share price itself can be volatile for reasons outside of the operating performance of the company. But when you get small companies early and everything comes together in terms of the people, the management, the opportunity, you don't need to get too many right to have a very, very good performing share portfolio. And we think about those structural changes that occur in the market. So digital transformation is very obvious. If we lost our phone today, most of us wouldn't be able to go to the bank. We wouldn't be able to do all sorts of things that are very, very commonplace. It's just the core of what we do and what we expect these days. We are all getting older, and that has impacts into whether it be healthcare, funds management, all of these areas. These are big themes that we seek to benefit from. And shifting energy and environmental factors are also really interesting space that we think can provide some opportunities in the longer term. But at the end of the day, a business model has to be sustainable. I've seen countless examples of a wonderful idea that management have either tried to do too much, take on too much, and not focus on the achievable and building blocks. But it's about being able to turn your business into something robust, sustainable, and something that grows and gets increasingly rewarded by the market the bigger it gets. So at our core, when we think about the way we do things, we're long-term investors. The market has increasingly become short-term focused. What's the next earnings result? Is it a beat or a miss? And then there's a 25-30% share price reaction to that number being met. There's more high-frequency trading. There's more quant funds. There's more passive funds that are providing more noise in the background, which creates opportunities. And thankfully, most of microcap companies are too small for them to be able to be investing in, but this is a trend we see through large and small cap investing. We're fundamental. We spend our time speaking to management, customers, suppliers, competitors, and understanding the business from the bottom up. We don't want to be pigeonholed in one particular growth, value, midpoint. We want to have a nice spread across the economy of different businesses. And we're bottom up. So that's all about getting out there and wearing out the shoe leather and really getting to understand a business. And I said, I'm very privileged to actually do this day in, day out and meet inspirational people, meet people that fail, that come back and try again. And, you know, the way that people end up getting to building something sustainable and great is, you know, a real journey to go on. Being responsible is important, whether for no reason that if you're not responsible and sustainable today, then in 5 years' time, if you're operating in loopholes and grey areas, then you're not going to have a business that stands on its own 2 feet. And the other thing is being disciplined. We stick to our investment process. You know, early on in my career, things that didn't go well became bottom shelf, bottom drawer stocks that, you know, would one day recover. If your investment case changes, sometimes you do have to cut and run because there are so many other great opportunities that exist out there. I thought I'd just quickly touch on 2 case studies. The first one's Pro Medicus, and this is why you do this. And I thought I'd just run through very quickly our investment process and what we saw. So this was an $86 million market cap business, had significant founder ownership and involvement, and they were passionate about what they were doing, and they had a strong strategic plan. And they had a large addressable market, and that's really important. And this is for the radiology industry and how they view radiology images. If you remember, you used to go in, have a scan, and they'd put it up on the board and have a look at it. Like the rest of the world, everything is now digital, and that's a difficult thing to do. And this little company in Richmond had a competitive advantage in doing this. It was really unique because it was profitable and dividend paying, which is not often the case in these small tech opportunities. And when we looked at the opportunity, it's again about a digital transformation, aging population. When you go in and have a MRI or a CT scan these days, the image that's produced is far more data heavy, and the things that can be done these days are incredible. And this technology has allowed that to be seamless. It's scalable. Scale's a really important thing. You build the software once, you sell it many, many times, and it's differentiated. So when you walk into a large hospital, you need to be able to say, there are 1,000 people trying to sell them. This can do something different. It can take a pain point away from you. It can be more efficient. You have to have a reason for operating. These are long-term annuity contracts, pay per click, minimum volume, so you're protected on the downside. And there was a commercial pathway that made great sense, and that's often the case. We see wonderful, wonderful products, yet their ability to commercialise and actually get through to people to say, I'm actually going to be the first person to give you a go, that's very difficult. We see that a lot. And today, they've got reference clients like the Mayo Clinic, which would be considered one of the world's best hospitals. If you can't view radiology images, your hospital doesn't function. You can't take risks in this stuff. Yet a small business in Richmond is at the core of what these companies do. When we think about risks, technology development, what's coming out of the woodwork, you've got GE, Siemens, big companies who are losing market share. What is going to be their competitive response? When you implement, you get one go. You don't have a second chance at getting that right. Pricing, competition, and like I think with the whole tech sector at the moment, valuation is an issue that people will think about. But in terms of a journey from 86 cents through to above $30, that's why we invest in microcaps. And it's satisfying to actually see a company achieve well and beyond what you had ever hoped that they could do in what is realistically a pretty short period of time. Another very quick example is a company called Aml Payments, and these are no longer microcap stocks, but they represent the things that have happened that can show examples of these powerful returns. This was a broken business that brought in a new CEO who was very well credentialed, very strategic in what he needed to do. It was unique. It had a very strong board. It had a lot of ex-top 100 CEOs and very people with big reputations that happened to sit on a small board, which is often something worth considering. Significant personal ownership, again, that idea of incentive is very powerful, and a credible commercialisation plan. Good product, but how are you going to get it into market? These guys are it's a prepaid payment solution, and they're probably best known for the technology that sits behind online gaming accounts, meaning that you can withdraw your winnings after you win. Previously, you went into the TAB, and that was the only way to transact to the full value. Online gaming was fantastic. Putting money in, getting money out was a problem, which is a great business model. But the fact is that with this technology, it has allowed them to compete with the likes of TAB, because you can withdraw your money, and the technology that sits behind that is an Aml Payments solution. They're across many, many verticals. These verticals are all growing strongly, and we think that there's, again, continued good upside in a business like that. But this was a broken company that brought in a new person who reset the strategy, took the core technology that was available, and has made a real fist of it. That's some fun performance information, and then very importantly, I'm very lucky to have 2 disclaimers, which is obviously important. But look, thank you very much for your time. Really pleased to see a conference like this, which is pushing stocks that don't get the limelight as much, and that potentially I'm really excited to see hopefully some businesses today that can deliver returns, as Craig said at the start in time. And I'd be happy to answer any questions if anyone had any.
So Michael should just go
Thanks, Joel. Great returns recently. Just interested, I guess we're all here for some sort of stock tips, but what's your view of the microcaps at the moment that potentially could be the big caps of tomorrow?
Look, it's a very good question, and that's what we're all here for. And again, all this is very general advice, but our fund's highest conviction positions at the moment are EnviroSuite, EVS is the code. For those that have followed the FOSLOC presentation from a number of years ago. And, you've got to remember about entry point 2. So the stock has re-rated significantly off the 8 cents we purchased it at, but at 32. So this is a company with software that allows environmental monitoring. Social license to operate is a massive issue. If you're causing trouble in the community from your plant or your mine or whatever it may be, regulation is pushing down very hard on that. So we just think it's a very, again, scalable solution. They've signed a really interesting deal in China, and we think that that's the kind of stock that certainly needs to prove itself to get to its valuation, but huge addressable market, and it's a solution that makes a lot of sense to us. Another stock that I still think has reasonable legs is Clover, which is the provider of DHA for infant formula. Has done very well out of the rise of A2 and Bellamy's over the last few years, but they have a unique way of encapsulating the DHA within infant formula. There are changing regulations around the world, which mean that that's going to become increasingly important. This is for eye and brain development in babies, and it helps to, it's a very scientific backed thing, and what we're seeing is regulation, meaning there needs to be more DHA in these products in time. And we also think that there's a big step out opportunity into sports nutrition and other areas. So there are a couple of interesting stocks where you never want to say to people, this is fantastic, it's going up in a straight line from here, but we think that they have nice long-term prospects, and there's, you know, risk reward, but they look pretty good to us.
What distributions do you pay, and are they franked, and are you usually fully invested, or can you increase the cash?
That's a really good question. We are here to deliver long-term capital growth, so the distribution that spits out is based on our trading activity. There is nothing planned around that. But I think one thing that people misunderstand about microcaps is there are plenty of fully franked, sustainable dividend-paying companies in the portfolio, but you're not there for a yield. So there have been situations where we've paid 8 to 9% based on needing to generate capital gains. But underlying all that, we try and be very tax efficient. So that means that I like to hold stocks for over 12 months, so I get the capital gains benefit from that. Really interesting example recently, GBST Holdings was a big portfolio position. There was a bidding war for that company. I could have sold that on market, but there's a 35-cent fully franked dividend that comes out of that from holding it for a little bit longer. We try and think about tax, but at the end of the day, we're trying to generate a long-term, you know, capital growth. So, yeah, it's not an outcome that's planned. It's just a result of the trading activity that happens. Cash is a really good question, and we can go as high as 25% cash. And the way that I always think about that is, microcaps are illiquid. I want to be fully invested. I'm hopeful that I can always find some great ideas at any point in the cycle. But if Armageddon hits tomorrow, having a buffer like that is in my interests as an investor in this product and the other investors in this product, because, you know, we saw what happened post GFC. If you can have some funds available when things are priced like the world is ending, and the case isn't so, that is a great opportunity for our investors. So we've never even gone close to that, but it is a nice guideline, mandate kind of guideline, which we're allowed to use.
Hi. Regarding to these emerging companies in future, as you mentioned, the most important things about the addressable markets and this sort of stuff, I would like to know what's your comments on the cannabis industry, like industrial hemp, and that one is more proven. They have more benefits to people, human beings, and also for the medical areas, but it seems like it's subject to a lot of regulations at the moment. Yep. So yeah. I would like to know your comments on this.
Yeah, so it's an area that we're going to be doing more work on. And as you said, it combines two things. Like, we look at Canada and we see the struggles that some of their resources companies have had in raising money, because cannabis has become the new great thing. And so people are piling into that in terms of these riskier trades as opposed to gold miners and things like that. But states are legislating, and the regulatory environment is becoming more clear. I'm not confident at this point in time that I have a great understanding of the industry and where it's going to land, but I think that it doesn't seem to be a fad. There does seem to be some momentum and evidence behind the fact that these are, you know, these are real opportunities for people, but you're always balancing up that, you know, your level of comfort and understanding, that you understand what the backdrop looks like, as compared to this is a great business, because things can literally shut down overnight with a change in regulation. So if I'm a payday lender and I used to charge people 48% and someone changes the rules, I'm out of business the next day. And you have to be very clear about what they're doing and the environment they're operating in. But we think it's an industry worth doing more work on and understanding, but I guess we're not yet at a point where we feel like we can make an investment.